Sorry. I couldn't get it.
Sorry. If for some reason demerger becomes a non-qualifying demerger, for some reason, XYZ, would it make demerged company liable to pay tax on that zero undertaking at the number date of tax?
Apparently, the way the laws are right now, no. And the case law is there, no. Because there is no consideration coming to the demerger.
Yeah.
What is the consideration?
But then, as you said, 50, if it's not measurable, you can,
The 50 again starts with the word consideration, approving or rising or receipt.
Fair.
So it presupposes the consideration being there.
Yeah.
So there also you can take a stand. Now the problem, okay, I'll tell you where the problem is.
Yeah.
The problem could come in case, and that's the next case which I'm talking about.
Yeah.
In a sort of a real estate situation, real estate business situation, where you are trying to color something as a real estate business, but when actually you are transferring only lands, in that particular situation, 50C may hate you. And they may just try to tax you on the stamp value.
Yeah.
But there again, there's a same word as 50D.
Yeah.
Consideration received or approved. So there also you can get away.
So you can get away like kind of.
You can, but litigation. Definitely, especially after Sorola, there will be litigation. Anyone else?
What would be the period of holding, sir, in the case of demerger, whether tax neutral or neutral? Is it very clear in the tax laws that the period of holding would be what the
No. So if it's a tax neutral demerger and you are compliant with 298, period of holding goes from the previous demerger. But if it's not, then we will become short term. Cost will not move the way it's prescribed.
you're talking about the assets that are transferred from the demerged company or the
No, I am about shares.
Share.
Assets then you open to fair value and so you're trying to get the asset base up in the demerged in the resulting company, so you get depreciation. Then you can get it, so there are both sides. So the next case law which I'm talking about is, I want to draw attention is the entire issue of undertaking test is become a very serious thing now, because very often there is hardly any activity and under the garb of demerger we are just taking it away and putting it into the resulting company. And this is more so in the situation where you are real estate business. So really you have to substantiate fully that there is a running business, there are people, there are lands, there are marketing people, there are different departments, finance departments, the business as a whole which is moving. So in the case of, in one particular case, as you know in the whole process, you have to go to regional director, and the regional director then issues notice to the income tax office for 15 days, now it's become 30 days under new law. And any comments which income tax office has, or any reservations we have on the scheme, we get back to our regional director. So in one such case, in the case of a matter pending with Rajasthan High Court, in the case of Umar Enterprises, what they did was they had 9 pieces of land in the company, and they demerged each land parcel into separate companies, resulting companies. And there was no business, they were actually manufacturing companies, and these land parcels were just put with some few assets just to show that there is some business into these 9 companies by way of a demerger. The regional director bought this, and what the regional director argued was that he tried to save taxes for 50C. Second thing he said that stamp duty you are trying to get away because the Rajasthan High Court Stamp Act, there you may be taking advantage of some formula which is prescribed for 391 schemes and having a reduced stamp value. Like in Bombay, you can actually, there is a formula based in Bombay Stamp Act where it's pegged to the value of shares issued, 0.7% value of shares issued in a scheme. So similarly in Rajasthan there was something like that, and which drastically brought down your stamp duty cost. And what is the biggest worry in a situation where you're doing real estate intensive sort of a scheme? It's stamp duty, and this is against the public interest. And on these 2 counts, we are allowing this to pass. So this was one such case in recent times where they have clamped down upon a demerger which is not really in the true sense of demerger, because undertaking is still not.
But still there was no transfer, right? The holders, the beneficiaries remained the same. So why should they basically contest this?
But there is an entity concept. So from demerged company A is a separate entity, B is a separate entity. So that's what we were trying to get through. But yeah. Similarly, okay, I'll proceed further. Examples. Okay, then there are a lot of judgments which have come in the case of slum sale and slum exchange. So slum exchange has another concept which has evolved in recent times. So before that, I will take up the issue of slum sale and the whole issue around how do you compute the capital gain when you slum sale a division from entity A to entity B. There is a formula prescribed in the Act. So what you do is you compare the consideration received against the tax net worth, which is prescribed under the Act, and the difference is capital gain. Now the case law is on the entire debate around what is tax net worth. So there will be a situation where consideration 100 and tax net worth 80, simple situation, 100 minus 80, 20, you pay capital gains and 20. But what happens in a situation where the tax net worth is negative? So in this particular case, transfer company has two divisions, division A and division B. Division B is transferred to transferring company at 10 crores and division B is loss making and net worth is negative, which is the case here. So what do you do in this case? Do you do 10 minus 15 and consideration is 25, or you do 10 minus 0 because how can you have negative net worth? And 10 is the capital gain. Any idea? Any? 25. There are both views, and Mumbai High Court has ruled differently in similar situations in both cases. So, in case of Zuari, Mumbai High Court has ruled that it takes 0 because it is ridiculous to take it as minus 15, minus 15, because then you are just paying for the asset, you are not taking into account the liability, you are transferring the liability. And in the case of, but this is a special bench decision of Mumbai High Court in the case of Sumit Securities, where they are taking the other view, which is 25 crores. And the rationale behind taking that view of 25 crores is that already it's a dealing fiction. The way you have to calculate the capital gains in the situation of slum sale is deemed to be the actual cost. So by saying that it is 0, how can you deem a dealing fiction already? So you have to strictly follow the formula. So even though the formula is negative net worth, you have to strictly minus 15 and then make it 25. Again, this is being litigated at a higher level. I don't know how many years it will take before we get a resolution on this, but this also is a bone of contention. The second debate a lot of people have is in a slum sale. What do we pick up as a part of business? Can we leave behind some assets? Can we leave behind some liabilities? Or necessarily you have to pick up all assets and liabilities? Even if the buyer doesn't want, you have to pick up and put it in the slum sale. So there, the decisions have been quite fairly favorable for the SSC, saying that whatever necessary to meet the going concern test in the acquired entity, you can pick that up. So if there are any fruitless assets which really not going to add value to your business in the resulting company which is acquiring the business, that really doesn't matter and doesn't actually vitiate your slum sale. So Delhi High Court in the case of Union projects has held that you don't need to carry all assets. Some assets you can leave behind. Only thing on day one when you have actually transferred the assets and the business into a new entity, it has to be proven that you are in a position to start business the very first day, turnkey. It should not happen that you are struggling to start a business. So it should be on a going concern basis. Similar decision of Bombay High Court in the case of premium automobiles. So this has been consistently followed. So this somehow has become, I think there's a lot of clarity on this front as far as institutional assets and liability are concerned. This is an important one. The undertaking consisting of investments. So this is important both in the context of slum sale and in the context of demerger. So very often we see that the company which is getting demerged has investment below, and the company, the holding company really doesn't have much of activity happening. It's purely an investment company and they have investment below. So the debate is, can that be said to be undertaking or a business which is happening when you demerge those investments per se into a separate company. Now, in this particular situation, there was UTV software which held shares in one of the operating companies, and it sold the shares in that operating company to XYZ company. The revenue said that this is a slump sale because you are transferring the business which is in that operating company on, and the control of that business in the operating company to the buyer entity. So it is slump sale. UTV argued that no, it's not slump sale. I'm just doing a pure share transfer, whether it is slump sale. And there the court has, Mumbai ITAT has ruled that you distinguish between assets and controlling interest based on the Vodafone judgment. So what you are transferring is controlling interest in that company which has those assets, and not really the asset per se as a business sale. So this clearly is a case of share transfer and not a case of slump sale. Now this decision is okay, done, very good, but this is a pointer that going forward, if you want to meet the undertaking test, you will need far more than showing just you are just moving investments. So if you have to transfer investments as a division, you have to show that there is a proper team, the proper treasury division, there are people who monitor those investments for the corporate, and is it a substantial activity which is moving as a business transfer, the demerger. So that is a key takeaway from this particular result. Although not directly on demerger, but the key pointer which we get from this is this. Any questions?
Sir, what about the latest circular of the CBDT, which defines what are the long-term and short-term capital gains of the company? But the end of the last line of the circular, it says that AO can create the dispute that it is a business sale and not capital gains.
Yes, so it's open. So we have to take it from each facts and circumstances in each case. So really, is it a business asset you're selling or is it a capital asset you're selling? So entire circular was good, except they put the last line. When they say that management control of it moves, then it's a business asset you're selling. So that is keeping the controversy alive actually on this spot.
There should have been a proviso that there should be some hanky-panky in that.
Correct, correct.
Actually, land is being sold and it is being given the shape of the share sale.
Correct.
Then AO should invoke those provisions.
So which
not
we serve will come now. If the guard comes from April 1.
Available to them from 1st April.
Correct. If it comes. Now let's wait for next how it pans out in the next
Even if it guard does not come, AO can invoke it.
Yeah, McDowell's, they can invoke McDowell's because of the circular. They can.
Sir, you spoke about exclusion of some assets. Now, when we talk about undertaking, what the entity, the undertaking that is being transferred needs to have some activity. Can I exclude all liabilities and transfer only, let's say, a plant? Okay, I don't want to transfer my debtors or receivers. It's maybe a family settlement where they don't want, they're just cutting off the transaction on an appointed date from which they are saying that till date whatever was the business is yours. From now on, I will operate the business. I just want the operating assets. I don't want the liabilities. I don't want the current assets. I just want the plant and machinery. Would that
Employees are moving.
Employees are moving.
That is a better case.
And what if they don't move the employees? Then
No, there is a problem because the house is running business.
Right. So
If you don't move the employees, but you have to have some arrangement
right.
where you know there is some cross charge happening or some two companies there and supplying the employees to do the work. But employees are most key. But it's not more of a problem from direct tax. Indirect tax could have a problem because some sales are not defined in direct tax.
Right.
So in indirect tax, they may say that it's an itemized sale, which means VAT exposure is there. So you have to be little calculated what you move, what you not move, just to be within the four corners of law and indirect tax. You may have to move a little bit of liability also.
So sir, in indirect tax, if undertaking is not defined,
No, there are in indirect taxes the way whenever I discuss with my colleagues, there are two schools of thought. One school of thought is some sale is not defined, so we'll go as per direct tax, whatever it does. Second school of thought is that what are you taking if you're not taking the liabilities over or undefined is the more danger area. So to actually be compliant with indirect tax, little bit of liability you take over, that should be better. See, it's not absolutely necessary for the business to run, but you have to be mindful because that cost will be high. Hi.
Hi, good afternoon.
Sure.
So I have this one query.
Don't call me sir, I feel very old. Vikram. Call me Vikram.
So for an instance, a foreign company one is transferring one of its undertaking to FO2, and the undertaking has investments in various countries, including India being one of it, and the transaction is taking place in lump sum consideration. Now, whether this particular arrangement would fall under 50B or 50D.
So foreign companies transferring investments in shares
Yeah.
in the Indian company.
Indian company, along with it, there are various investments from other companies. So it's a consolidated, the merger would be in a consolidated consideration.
So it's just a share transfer, right?
Yeah.
The foreign company is transferring shares of Indian company, is transferring shares of other companies as well across the globe
Yeah.
into another company,
Yeah.
foreign company.
Yeah.
So it's a straight case of taxation in India because Indian shares are being
Yeah.
transferred.
So that would be under 50B or
It
50B.
will be a share sale. It's a share sale, purely. Anyone has a different view, please feel free.
So if I'm computing gains, for instance, if it's in a business, not just shares, but along with it, if it's generating income also from companies here in India, like from the Indian company where it has invested a substantial
So
amount.
it's earning dividend income from the Indian company.
I am talking just about whether the consideration which I would be receiving from that, if I have to compute capital gains. So from what particular section will I be computing it under? Whether it would be 50B, because I won't be able to determine or ascertain the income of Indian companies foreign direct. So whatever Indian shares is. So for instance, 50B.
So you're getting a consolidated consideration.
Yeah,
So
consolidated.
then you have to go for 50D. You have to go for 50D, and then you have to allocate how much is the fair market value to the Indian group and do it. Because there it clearly says you are receiving a consideration.
Yeah.
So if it cannot be determined, you have to go to fair market value. Should I proceed? This is more exciting, Islam exchange. Lot of case law on this. So
In case of undertaking, this is negative will work. In case of an undertaking, which is negative will work, it is transferred to reserving company under scheme of arrangement. Under scheme of arrangement, there is no consideration to the either to the shareholders of the main company or to the main company. It will be some share or demerger for the purpose of income tax.
So this is exactly what the case of Avaya Global Naik, where they ruled that there is no consideration received by the company which is transferring, and no shares also issued to the shareholders. So there is no tax because competition mechanism fails.
So it will not qualify as demerger.
It is not demerger. You will not issue shares.
It will not qualify as a slum sale.
It will not qualify as consideration because there is a consideration coming.
My consideration is zero. Less negative, less 10.
Okay, that you are saying. So you are saying zero. Okay, so you are doing a slum sale.
No. The scheme of arrangement is for demerger only. But for the purpose of taxation, one of the conditions that shareholders of the main company to get shares.
Correct.
That will not satisfy because there is no consideration.
There is no value in the company.
Yeah. So do it classify as a slum sale? And
In light of this, 0 minus whatever is your liability, you will be caught. Because liability adoption is also a consideration. Should I proceed? So, slump exchange, very innovative sort of thought process, playing on the words of the income tax law. So, slump sale is defined as sale of undertaking for a lump sum consideration, a transfer in nature of sale for a lump sum consideration. Sale has not been defined in the Income Tax Act. So, one has to go to Sale of Goods Act or you go to Transfer Property Act. And the sale, the way it's defined in those acts is that it has to be for a price, which the money is worth, or some consideration for whatever you're transferring the business for. Now, in slump exchange, in some cases, what it did was the company moved the business from say A to B and cash was not exchanged for that transfer of business. What was issued was shares or bonds for a transfer of business. And the argument taken was that this is actually not a slum sale because there is nothing like money's worth which defines the scheme. All you are doing is exchanging your business for shares or bonds in the buyer entity. So it's an exchange. Now the question arises is, it's an exchange, fine. Transfer includes exchange. Am I right? Transfer includes exchange. So in a situation where transfer includes exchange, why it should not be taxed? That was the revenue's contention. The argument of the SEC before that was, okay, you tax me in exchange, how will you tax me? What will you do? I know fair value of shares is what is issued. That is the fair value of shares, that is the consideration. How do you work out the cost in my hands? There is no way you can work out the cost in my hands because the formula which you call a deeming fiction to work out the cost in a situation of sale and a slum sale is meant for slum sale. So the tax network formula which we follow in a slum sale cannot be extended in a slum exchange situation. And there have been case laws earlier which says that in a situation where all you are doing is transferring your running business or going concern to another company, in that particular situation, cost of that going concern cannot be computed. So based on Supreme Court decision in the case of BC Srinivas Reddy, the competition mechanism fails and there ought to be no tax. So on all accounts, even if it's an exchange, you're not able to tax me. So don't tax me. And this is exactly what happened in Bombay High Court in the case of RRCs. They did this particular slum exchange in a scheme, and which was again approved by the High Court. Bombay High Court also followed that same judgment and actually said that this is not an exchange. In terms of what we understand, this is not a slum sale, no tax. Now, what this results in is twofold issues. While we have addressed the issue under normal income tax for slum exchange, based on whatever the judgment speaks about, what happens in a MAT? Bharat Bujri being a loss-making company, obviously, book losses, there was no MAT. So that was nowhere mentioned in the judgment.